Good afternoon and welcome to CanadianAgMarkets.com. My name is Brian Como. Today is Friday. I always forget what day it is. It is Friday the 18th today. Did I say that it was the 19th yesterday? Because I might have said it was the 19th yesterday. Anyway, I never remember what day it is. Today's Friday, though. That much I know. And I got a quick and dirty market update for you because you boys got plans. All right, let's get into it. Today's close today. Canola managed to settle above 700 today, rallied earlier in the session and came off. Still closed above 700, 730 cents, up 40 cents a ton today. Minneapolis wheat up 3/4 of a cent at 616.50. That was the lowest performer in the wheat complex today. Kansas was up 11.5 cents at 529. Chicago was up 12 3/4 at 546 1/4. Soybeans were up 9 1/4 at 1035 3/4. Soybean oil ended the day down 56 points at 55.59. Corn up 6.5 cents at 408.50. The Canadian dollar a little bit closer to 73, 72.85. Live cattle took a breather today, down half or 50 cents. 100 weight at 219.82. Feeder cattle down a dollar at 324 100 weight. All right, I do have, or in our weekly report today, we also kind of talk about the week over week closing futures values. I think this can kind of give us some trends that we don't necessarily see by aggregating each day one at a time and kind of forgetting what we did. So this is a snapshot of the closing futures values, the weekly closing futures values that we put in our weekly report. If you want to get access to our weekly reports, subscribe to our premium content at canadianagmarkets.com/subscribe. We'll get you set up right away. It's only 99 bucks a month, cancel anytime, and we send out lots of stuff every week. All right, week over week, we saw some good gains in canola, $17.80 up. We saw modest gains in Kansas, 6 cents. Chicago, 4 3/4. Soybeans were up almost 30 cents at 28 3/4 cents. Soybean oil, about a 1.6 cents a pound. And again, we saw amazing performance out of the live and feeder cattle. They trade closer to their highs as well, even after the small losses that we saw today. All right, let's get into some charts. Here's December corn. We're going to start with the grains before we get into the oil seeds today. December corn. I like this chart today. It broke the 20-day moving average. I think that there's possibility to get in between that 435 and 445 area, maybe even higher. We could see it up to 450 if this rally continues. It's one of those things where crop condition ratings kind of leveled off. A lot of the good weather news has probably been baked in, although this market still looks bearish, right? There's still a lot of lower lows and lower highs here in this market. We could be in for a bit of a rally here, particularly if it does get, hotter or drier in the Midwest, or if crop conditions plateau and profits want to get taken on the short side, then I could see there being a little bit more of a continued rally here. Here's the wheat after today's rally. Chicago wheat came up and tested that 20-day moving average, also the 50-day moving averages. Those two have kind of converged there. We have kind of seen Chicago wheat level off here, seeing some support in that, in between the 530, 540 area. Not sure where that's going to take us. Obviously, we have support also down at about 522. So doesn't look bearish, looks more neutral than anything else this wheat market. September Kansas wheat also saw some gains, also pulled right up to the 20-day moving average, but wasn't able to break above that yesterday. Still good gains in Kansas today at 11.5 cents. We could see some follow through here just because we're getting close to the end of the HRW harvest. So the pressure from the harvest may abate to some degree, but overall, again, this looks more neutral to me than bearish. Actually, if we did break to a new low, kind of towards that $5 area, maybe even if we see a 4 in front of it, that would be concerning. But I think we are seeing some bargain buying here, some good values here in the winter wheat complex. Minneapolis wheat, bit of a different story. I think we could pull this back down to 605 still. There's a little bit of bearishness that I still have in this chart, even given the gains. Actually, the gains today being significantly less than they were in the winter classes also signals that there's a little bit less favor in the spring wheat right now, but there is probably some support at that 605 level. Anybody who got sales off earlier for a new crop is probably happy about themselves at this point. But it's more. I'd say we're closer to the lower end of the range at this point in time. Of course, that doesn't mean that I'm right, and that will mean that the bottom will come in near that $6 area again. But it is hard to trade Minneapolis wheat below $6 with a five in front of it. You know, farmers tend to walk away from the bin at that point, just close the door. December soybean oil saw some really good performance today. We saw it break to a new high today, at least a new short term high. So now we have gotten above levels that we saw after that initial shock from the EPA announcement, where we saw two limit up days. So now we're trading at higher levels than that, or we did trade at higher levels than that earlier in the day. We snuck up, through the week this week, and saw good performance out of soybean oil. We also saw lower than expected stocks of bean oil after the NOPA report this week as well. So good things happening in the soybean oil complex that is kind of filtering into some of the other markets as well. Here's palm oil, which does take some cues from soybean oil, but soybean oil also takes some cues from palm. So they're kind of interconnected to some degree. We saw good gains in the palm oil market today, up to 43.50 ringgit, settled down at 43.15. Didn't make a new high, but it is kind of trading close to those highs. So there could be some resistance up in this area from a futures standpoint. But I think traders are just becoming a little less confident on the oversupply situation of tropical oils in that Southeast Asian area. So it is kind of trading back towards those late winter highs at this point, and that's helping the rest of the vegetable oil complex. Soybeans had a good day today. As you can see here, it kind of came up and tested that trend line support down. In the last month and a half, we have seen lower highs and lower lows here. So this could be a rally into up until that trend line support. We could see it fail here. This would be the risk that we see in soybeans. Again, the bean market itself is still relatively well supplied. In our morning commentary this morning, I sent out a chart showing oil share, which got near 50% today. So the one thing about soybeans is that as we get oil share close to 50%, I mean, that's 20% of the crush output generating 50% of the revenue. That's a relatively high number. So as a result, soybean prices get more and more correlated or sensitive to the price of vegetable oils. That may have helped soybeans out today a little bit as well. But the fundamental picture for soybeans overall is still relatively well supplied. So I wouldn't expect any major fireworks, at least from the fundamentals specifically in soybeans. I think what we need to see is it to continue in the vegetable oil space in order to continue to see gains in soybeans. Here is November canola. Again, actually some similar things here to soybeans. We kind of saw it go up and test trendline resistance. It did break the 20-day moving average. I do like that. We have seen some, short-term, lower lows and lower highs. It almost looks like we are trading kind of a channel lower here, which can be a good sign if it does decide to break above the channel. If we did break above the channel, there is resistance there at 730. There's resistance at 750. But for any of those farmers who feel like they missed out on pricing 700 or above canola, we have that opportunity again now. I also did see that basis levels were improving. We saw actually a very low producer delivery into process facilities last week, according to CGC data. So that either means that the elevators are pulling less, or farmers just aren't delivering as much. And what we saw in the basis market, over the last couple of days, is we saw some premiums, we saw some increases in basis. So I don't think it's that. I think it is that the crushers are still looking for some product into the end of July. They haven't gotten it yet, and so they are trying to incentivize some late July delivery of canola. All right, that is all we have for you today. Thank you for joining us. Have a great day. We will see you again next week.